let's just dive right into this explainer and unpack how a dense 12-page financial report actually reveals a massive, completely unexpected quarter for a major metals provider. Today, we're looking at the Q2 2026 earnings for Reliance Inc. They are the largest metals service center company in North America. And let me tell you, this report, it is just packed with fascinating insights about where the industrial economy is actually heading. Right out of the gate, Reliance reported a staggering $4.63 billion in net sales. I mean, wow. But it doesn't stop there. They also posted a 42% year-over-year jump in earnings per share, hitting $6.29. In the world of metal distribution and processing, where, margins can be incredibly tight and the competition is fierce, these kinds of numbers are absolute head-turners. It's a huge beat, and it tells us something very specific is happening under the hood. So here's our roadmap for this explainer to see how they pulled this off. We'll look at the record-breaking Q2 results, the border wall boost, how they're navigating rising material costs, end market performance, cash, dividends, and debt, and finally, their Q3 outlook and beyond. All right, part one, record-breaking Q2 results and how they are just smashing expectations. Now, the top-line numbers are incredible, sure, but look at the sequential growth here. That is a 15% increase in sales just over Q1 of this very same year, and their non-GAAP pre-tax income up an absolutely incredible 41% year over year. You guys, these aren't just incremental gains. This is a company operating at full throttle. They're moving record volume at a time when the broader macroeconomy has honestly been sending us some pretty mixed signals. And this right here is absolutely crucial. When you compare Reliance's 10.8% volume growth against the broader industry average, which is tracked by the Metal Service Center Institute at just 5.5%, well, it becomes pretty clear they are aggressively taking market share. They were growing at nearly double the rate of their peers. That speaks volumes about their scale, their processing expertise, and their sheer ability to secure inventory when lead times at the mills are really stretching out. So, to give you some context on what they're actually moving out the door to achieve this, let's look at their product mix. Over half their sales, about 55%, come directly from carbon steel. That is the foundational metal for construction and heavy infrastructure. But, it's balanced out really nicely by healthy portions of aluminum at 17% and stainless steel at 12%, which supplies slightly different manufacturing and aerospace needs. So what we're looking at is a highly diversified portfolio, which really insulates them quite nicely from shocks in any single commodity. Moving on to part two, the border wall boost. This was definitely an unexpected catalyst. As CEO Carla Lewis points out here, a major and honestly unexpected catalyst was a U.S. Department of Homeland Security border wall contract. Now, they were awarded this contract earlier in the year, and the activity levels in Q2 came in way, way above their expectations. Now, regardless of the politics surrounding government infrastructure projects, if we look at this strictly from a business and earnings perspective, this contract acted as a massive accelerant for Reliance this quarter. Just look at how profound of an impact that single contract had. It single-handedly added 5.1% to their sequential tons sold. It contributed 41 cents to their earnings per share, which, by the way, more than doubled their initial estimates of just 15 to 20 cents. Now, interestingly, it actually pulled their average selling price down by about 1.6%. Why would that happen? Well, the border wall requires heavy volumes of specific lower-priced carbon steel products, so that naturally shifted their overall product mix. But because the volumes were just so incredibly high and the operating costs to process this specific order were below average, it ultimately expanded their overall profit margins. A real win-win for them. All right, Section 3, navigating rising material costs and the LIFO impact. Now, it wasn't all just smooth sailing. Throughout this earnings report, the term LIFO expense pops up constantly. LIFO just stands for last in, first out. It's simply an accounting indicator. Basically, when you see LIFO expenses rising, it means the costs of purchasing raw materials, things like carbon steel and aluminum from the mills, are rising quickly. The company is basically expensing their newest, most expensive inventory first. To put that into perspective, management originally expected a LIFO expense of just 54 cents per share. The actual hit? A whopping $1.64 per share. That is a massive $1.10 per share negative hit to earnings just due to those higher than anticipated material costs. So the really crucial takeaway here is this. Reliance achieved record-breaking top and bottom line numbers, despite facing a massive, totally unexpected cost headwind. That makes their earnings beat significantly more impressive than it even looks at first glance, because it proves they successfully passed those higher costs right onto their customers.
Let's jump to part 4, end market performance, or where the metal meets the road.
So beyond the border wall, who else is buying all this metal? Look at the sheer breadth of demand across the industrial spectrum here. Everything is flashing green. Non-residential construction, which is their largest market, is being driven heavily by the absolute boom we're seeing in data centers and energy infrastructure. The broader manufacturing sector, it remains really healthy. Commercial aerospace is seeing gradual build rate increases, and semiconductor demand has meaningfully improved. When a foundational metal supplier sees strong demand across this many diverse sectors, it's generally a very, very strong indicator of broader industrial economic health.
All right, number 5, cash, dividends, and debt. Let's check in on their financial health. Pivoting to the balance sheet, Reliance generated a really robust $162.2 million in operating cash flow. Now, you might notice that's a little bit lower than some previous quarters, but there's actually a great reason for it. They had to fund a massive increase in working capital. Think about it. When you are shipping record tons of metal and the price of that metal is going up, you have to spend a lot more cash just to keep your inventory stocked. But even with that heavy reinvestment back into their own inventory, their liquidity remains incredibly strong, with total debt to EBITDA sitting at a very, very comfortable 1.1 times. And for the investors watching us today, that strong cash flow enabled the board of directors to declare a really healthy quarterly cash dividend of $1.25 per share. Now, they didn't buy back any stock this specific quarter, but they were quick to note they still have about $529 million authorized and ready to go for future share repurchases. So capital is absolutely flowing back to the shareholders. Finally, part 6, Q3 outlook and beyond. What is next? Looking ahead to Q3, management expects core volumes, excluding the border wall stuff, to dip by about 2 to 4%. But hey, don't panic. That's just normal seasonal behavior for the metals market in the late summer. Pricing is actually expected to stay flat or even tick up slightly. But the real headline here is the earnings projection. They are guiding for a massive Q3 non-GAAP EPS between $6.40 and $6.60. And a big chunk of that, it's because they expect that border wall project to accelerate even further, contributing roughly another 60 cents per share in the upcoming quarter at margins that are above the company average. So the crucial takeaway from this explainer is this. Reliance is basically executing flawlessly right now. They are aggressively taking market share, effectively passing on raw material costs, and capitalizing brilliantly on unexpected government contracts. But management was also quick to point out some looming macroeconomic risks, things like domestic and international trade policy uncertainties, and global conflicts that could easily disrupt supply chains. So the question I'll leave you with is this. With these macro clouds forming on the horizon, will this incredible momentum actually continue into next year, or have we just seen the peak of the metal cycle? It's definitely going to be a fascinating space to watch. Thanks for joining me for this explainer, and as always, keep learning.